So you may be wondering, how do I even get started and how do you buy stocks? Well, it's quite easy actually. Anyone can trade stocks. You don't have to become certified and obtain a special license. You don't have to go to school for it. You don't need to pass a background check. All you need is access to a computer and internet. And you need to have money to purchase stocks and be able to open an account with an online broker. Now, opening an account with an online broker is much like opening an online bank account. You fill out an application to open the account, then deposit money into the account, and then once your account is funded, your broker will provide you with special software to download on your computer so you are actually able to buy and sell stocks. Now, this software differs from broker to broker, and they all come with different features such as charts, market scanners, news feeds, financial statements, analyst ratings, and much more. Once you log into the software, you're able to choose which stocks you want to trade by typing in the stock symbol. The symbol is an abbreviated form of that company, and this symbol is completely unique to that specific company. So Apple symbol is AAPL, Facebook symbol is FB, Ford is F, NVIDIA, NVDA, Intel, INTC, and all publicly traded companies are assigned an abbreviated symbol, and that's what you're going to use to search and identify stocks. So once you type in the symbol, you'll be able to choose how many shares you want to purchase and how much you want to buy and sell them for. And all the decisions are going to be up to you. There's no middleman or advisor you have to go through to buy or sell stocks, although you can hire a licensed professional to do it for you. But if you choose to do it yourself, all you have to do is type in the symbol in your order entry window. You can type in the number of shares that you want to buy or sell. You can select the order type, which we'll go over here in a second, and you can specify the price where you may want to buy or sell them at. So let's say that you want to buy 100 shares of Apple right now. You click the buy button, and then the stock price goes up. And then once it goes up, you're in the money, you decide to sell. Well, the money that you made will take a few days to clear, but once it's cleared, it will go into your broker account balance where you are able to freely transfer from your broker account to your personal bank account. And then you can use that money for whatever you want. You can pay your bills, you can go out to eat, save for a new car, whatever. Well, sounds easy, right? Well, not so fast. It's easy to get started, but the very first thing you need, also the most important, is to get educated. If you plan on long-term investing, you need to be educated on how to design a long-term portfolio and what to do in tough market times. If you plan on swing trading or day trading, you need to learn successful strategies and how to manage your risk. Trading stocks is extremely risky without the proper knowledge, and this is why most people fail. The market seems like an easy place to make money. If you pull up any stock chart and look at it, it's easy to say, oh, I could have predicted to buy here and sell here, and if I would have done that, then I could have made X amount of money. And I say that because I said the exact same thing, and any trader who's been around long enough would tell you the same thing. Charts that are already printed are viewed with 20/20 hindsight, and this is probably the number one reason so many people start using real money, because they think they have figured out the secret. I'm not trying to be condescending or tell you that you don't have things figured out, but I'm just trying to tell you that looking at charts in hindsight makes things look really easy. But when trying to profit in real time, it's much harder than you think. And I want you to be aware of this so that you start slow and take the time to practice. So before even thinking about opening an account with an online broker, you need to educate yourself. And if you plan on actively trading, you need to practice using a simulated trading account before diving in and using your real money. So this is a screenshot of the charting platform I use, and what's really cool is that it comes with a paper trading feature. And down here, there's a paper trading tab. You click this, and this order entry window box will pop up, and notice here it says paper trading. Paper trading is the same thing as simulated trading. It's just fake money. So what this is going to allow you to do is help you practice buying and selling stocks. You can type in the amount of shares that you want down here. You can type in the price, and then you can click the execution button, and it's going to just help you understand how the market moves, and it's going to help you understand how the different order types work, and it's going to help you practice different strategies that you come across. So it simulates real trading, but it's all fake money, so it's no risk to you, right? So I highly recommend every new beginner, they play around inside a paper trading account just so they can get the feel of how to place orders. Now, there are all kinds of ways to trade. As we've learned, there are three main methods to make money in the market: investing, swing trading, and day trading. But within those three major methods, there's all kinds of different styles and strategies. Now, one style isn't necessarily better than the other. They all produce results in a different way, but as you begin your stock market journey, it's important to test out different styles and methods and see what you like the best. Now, you probably don't need a simulator for long-term investing, but for actively trading, you want to figure out your niche. Some people like swing trading based off indicators, and some people like day trading reversals. It really just depends on your risk tolerance, your personality, and your abilities. And that is what the simulator is going to help you figure out. I found out that I like day trading breakouts. For some people, trading breakouts may be too fast and complex. You won't know until you try it. And using a simulator will help you with that, all while not risking a penny of your money. Now, it may make sense to try to learn and master all the styles so you can capitalize on more opportunities, but it's actually going to hinder your performance. You want to be a master of one method because that is literally all it takes to be consistently profitable from the market. If you try to be a jack of all trades using all these methods at once, it's going to take a very long time to find consistency. Figure out which method you like and solely focus on that one method. You'll be able to master it much faster than if you were trying to become good at everything. Once you've mastered one, you can move on to another method if you feel like you need to, but do it inside a simulated account. So when you're practicing buying and selling stocks, you have to specify a few things: the number of shares that you want and the type of order that you want. The order type is going to place certain rules on how your buy or sell order will be executed. So depending on your broker, you may have a few different options, or you may have many options, but these are the three main order types: the market order, the limit order, and the stop loss order. A market order is going to be a buy or sell order that immediately executes at the current market price. Whenever you type in the number of shares and then you select the market order as the order type, your broker will go out and get you all the shares that you specified at whatever the current price is. There's no waiting or hassle in getting your shares filled. It's meant to quickly get in and out of trades. A limit order, on the other hand, is a buy or sell order that only executes at a specific price. Whenever you use this type of order, you select the number of shares you want, and you also specify the exact price that you want to buy or sell at. Now, this type of order gives you more control over your entry and exit prices. So let's say, for example, the current stock price was at $60, but you only want to purchase this stock if it comes down to $45. Well, you can use a limit order to buy the stock at $45, and you can go ahead and send your order to the exchanges. And once there is someone willing to sell you shares at $45, only then will your order be executed. Another thing I need to point out here is that there is the possibility you may not get all your shares you specified. Limit orders only fill at specific prices that you enter. And if there's not enough shares to be sold to you at that specific price, you may end up receiving what is called a partially filled order. So that's one of the risks when using limit orders. The best way I can describe the difference between a market order and a limit order is like buying a house. The owner of the house is asking $200,000 for his house. If you want the house and you want it fast and you want to buy it before anybody else does, you just go ahead and pay the $200,000. That's a market order. But if you don't want to pay $200,000 for the house and you go up to the owner and you say, "Hey, I don't want to pay $200,000, but I'll give you $180 for the house." This is like using a limit order. You're only going to buy it at a specific price. Now, the stop loss order is an order that triggers a market order once a specific price is reached. So this type of order is commonly used to limit the amount of money that you may lose on a losing position. So when you go to place this type of order, you specify the number of shares, you select the stop loss order as the type, and then you select the price at which you want to sell the position if the price reaches it. So what's going to happen is, let's say that you bought the stock at $45. The price did come down. You got in at $45. But if it reaches $30, you want out of the position. You don't want to risk the price going down even further. You say, if it comes down to 30, I just want out. I want to accept that I lost on the trade. I want to limit my losses. So if the price does come to $30, your order will execute as a market order, meaning it will sell at whatever the current price is at the time, and you'll be out of the position. Stop loss orders are your protection, and they are a must. Before entering into any trade, it's best to have a stop price in mind so that in case you are wrong, and you will be from time to time, the loss isn't going to completely wipe you out. So it's important to get familiar with these different order types and practice using them, because you might be in a situation where it may not be best to use a limit order, or it may not be best to use a market order. So as you get more experience, you'll start to understand and be more comfortable using different order types in different situations. All right, so I got my charting platform opened up right here, and we're going to do some simulated trading. So down here, there's a tab called Trading Panel. I'm going to click on this, actually move this up. And over here on the left, Paper Trading. I'm going to click on that. So what this is going to do is give me a simulated account to trade with. And you see down here, account balance is $100,000. So it's acting like I have an account of $100,000. And I can change this. I can just click on this little person right here, click reset trading account. And let's say that I only have $25,000. All right, so I just click reset, and now my account balance is $25,000. So I can act like I have a $25,000 account and trade. All right, so when I want to make trades, I come over here to this up-down arrow tab, click on that, and this is going to be my paper trading order entry window. So let's say I have Facebook open right here. Let's do Apple. Let's say I want to buy Apple. I like Apple. Maybe I don't really care about the price. I just want to get into Apple. Well, if I just want to get into it and I don't want to mess around with finding the best price, I can just simply use a market order. So come over here, I'll click market, and then all I have to do is type in the number of shares I want. So let's say that I want to buy 50 shares of Apple. All right. All I have to do is make sure the buy is highlighted. I got my order for 50 shares, and then click buy. So since this is a market order, what this is going to do is immediately execute. It's just going to go out, get me my 50 shares, and I'm in. All right, so down here, it says that I got in at $220.66. Right now, I'm up $3.50 on the position. And what's cool about this paper trading account, it shows a line right here and an arrow of where I got in terms of the time. So I got in at 10:52, and it shows it over here on the price scale as well. So really cool feature right there. So let's say that I'm in right now, and I think that, you know, Apple is going to go up, and I want to sell for a profit. So let's say that I want to sell if it gets to $221. Well, if I click the sell button and I use a market order to sell, it's going to sell immediately. That's what a market order does. It doesn't wait for a certain price to hit. So if I want to sell this stock at $221, I have to use a limit order. So when you do a limit order, you click on limit, then you have to type in the price that you want to sell it for. So we'll type in 221 on here, and then you type in the number of shares. So I'm in the position for 50. So I want to sell the entire position. You can sell half your position, whatever, but we're going to do 50 shares, and then I'm going to click sell. So what this is going to do, my order is placed, but it's not going to execute until the price comes up and there is someone willing to buy my shares at 221. All right, so this is a live order on there. It's just sitting there out in the queue. And only if the price comes up to 221, that's when my order will be executed. Now, let's say that I'm in this position right now, and I want to protect my losses. All right, so I want to sell if the price gets down to 220. If the price goes down to 220, I want out because, you know, I want to limit my losses. Well, this is where a stop loss order is going to be. So I click on stop, and I have to specify the price. It's kind of like a limit order, but once it executes, it's actually going to turn into a market order. All right, so I click stop. I want out at 220, 50 shares. I click the sell button. So now that order is live, right? It's out there, it's placed, it's sent to the exchanges. Only if price comes down to 220, then my order will actually be executed. So right now I have two different orders. I have an order to sell for a profit if it gets up here, and I have an order to sell at a loss to protect my loss if it comes down here, right? So those are placing different order types, and you can see how valuable a simulated trading account can be when testing out different strategies, learning how the market moves, learning how to place different order types in different situations. It can really help you understand before risking your own money. Well, when can you practice and make trades? Well, you can only make trades when the market is open. And the market is open every weekday except for major holidays. If the holiday falls on a weekend, the market may be closed either that Friday or Monday to observe that particular holiday. And the time the market opens each morning is 9 a.m. Eastern Standard and closes at 4 o'clock p.m. Eastern Standard. Now, this time period is the normal market hours. This is the time frame where most of the institutions, the big-time investors, and most traders trade. So this is the time where you will see the most activity. But there are times during the day that you can trade that falls outside of this time period. And these are called extended hours, known as pre-market and post-market hours. So pre-market hours are from 4 a.m. to 9:30 a.m. Eastern Standard. And post-market hours are from 4 p.m. Eastern Standard to 8 p.m. Eastern Standard. Now, depending on your broker, these times can vary. Some brokers allow you to trade starting at 4 a.m., some allow you to start at 9 a.m., and some don't even let you trade in extended hours at all. So check with your broker to see when you are actually able to start trading. Now, a word of caution about trading in pre and post market. The activity in these extended hours is very light, and when there is not much activity going on, you can see some major swings in price movement, and you may have trouble getting in and out of a position at the prices you want. So as a general rule for myself, I typically avoid extended hours trading. I find I have much better success during the regular market hours. All right, so I hope you all learned something. Thank you so much for watching.